Now, as promised, let's move forward and talk about the gas space. The first GST Council meeting under the new NDA government is likely to be held on the 22nd of June. Sources indicate the Fitment Committee could study the Oil Ministry's proposal to bring both aviation turbine fuel as well as natural gas under the GST ambit. And this could happen just ahead of the meeting. To discuss about this, more than the possibility, the impact really, and this has been a long-standing demand and what it could perhaps mean for a lot of gas players and also airline companies. We've got Probal Sen joining in. He tracks the energy space very closely at ICICI Securities. Probal, happy Friday to you. Thank you for joining in. If this indeed turns out to be true, I'm guessing it'll be a very happy Friday for a lot of people in the gas chain, right? Can you start by sharing some ballpark estimations of how much is the benefit, say, to city gas distribution companies, something like GAIL, etc.? How do the benefits start flowing in if indeed gas is brought under GST and the whole chain has access to the input tax credit claim?
Yeah, it's very difficult to put it into numbers right now, to be very honest with you, because we don't even know what rate will eventually be applied as and when, or if rather, gas comes under the GST. Qualitatively, one can basically very clearly say that once gas is brought under GST, it has two clear benefits. One, from a gas consumer standpoint, specifically industrial users of gas, they have been unable to claim input tax credit even if their output is actually being taxed on GST so far, if they're using natural gas as an input, except for specific cases where they have to put end-use certificates and so on. But it's not a blanket allowance that has been given since gas was not part of GST. So that immediately, again, depending on how much of your cost of raw material is natural gas, that immediately opens up, significant cost savings as a gas consumer, and immediately makes gas much more competitive versus alternate fuels like other liquid fuels, which you might be getting benefits on. So that is number one. Secondly, even for the companies like city gas distribution entities, and this is something Mahanagar Gas has already alluded to in their analyst briefing that was held last week, is that there are elements of operating expenditure as well as capital expenditure on which there is a GST liability, which you are unable to claim any credit on since your final product is out of the GST ambit. So there are significant cost implications, and from a margin standpoint, if it allows you to pass that benefit through to customers and maybe retain some benefit, a 1 rupee movement in terms of your gross margin can easily shift earnings by as much as anywhere between 8 to 18%. MGL probably about 8 to 9%. It's about 12 to 13% for IGL. And Gujarat Gas, which traditionally has a much higher operating leverage, that can see a benefit of close to 17, 18% if there is a 1 rupee improvement in your gross margins as a result of these measures. On a more macro level, if GST actually comes through, for gas demand, obviously that's better news, as I said, because it makes things more efficient and it makes things more affordable, both from a supplier and a customer standpoint. So for a company like GAIL, for example, obviously the higher demand brings into focus the fact that the utilization of their new pipelines, specifically in the east and the northeast, as well as the existing pipelines, can actually go up. Remember that utilization of GAIL's transmission network is still at only about 50% and is likely to go up to only about 60%, even with a decent growth in the next 3 years. So any delta on that, I think, is something that is something that could be a positive. In LPG segment, it could probably see a benefit because of retaining the benefits of the GST.
Probably just clarifying the range, you said 1 rupee improvement in margin can improve earnings by 8 to 18%. That's across the city gas distribution space, right?
Yes, it's about it's about 8 to 9% for NGL, about 13% odd for IGL, and close to 18% for Gujarat Gas, as per our estimates. This is not really a calculation done in terms of only GST. I'm saying a 1 rupee movement in terms of gross margins
can actually due to any issue. Yeah.
What about, the rates itself? You said that we don't have any clarity on whether this happens, whether it'll be 12%, whether it'll be 18%. I'm sure you've done some scenario analysis, right? If it is 18%, what could the benefit be? If it is 12%, what could the benefit be?
I think the number that was mentioned was, or the expectation of 12% means that there could be a mid to, low to mid-digit improvement in terms of competitiveness, specifically, let's say for Gujarat Gas, given that their propane to gas competitiveness is something that is very important. You could probably have a low to mid-digit improvement in terms of cost. But for the others, I don't have any clear numbers as of now. We would like to wait for the rates to come out and see how it is implemented before giving out a estimate.
Okay, all right. Probal, hi, good morning. Good to see you on the show. Nigel on this side. Probal, if ATF comes under GST, we know it's positive for aviation companies, but will it have any kind of impact on OMCs as well?
I don't think so. I think a tax is a very clear pass-through in either case. So while it is not exactly a regulated product and the pricing is done on a market basis, but reduction of tax, I would expect would probably need to be passed through as it is. I don't somehow think that it can actually have a huge impact in terms of margins for the OMCs.
Right. X of all of this, what is your view currently on some of the companies? Oil prices are firming up once again around 82. What's your thought on ONGC? What's your call on GAIL? X of all these GST related issues.
No, I think our view hasn't changed much. One thing that we've always maintained is that as long as crude remains in a certain range, and when I say range, I mean somewhere in the $75 to $85 range, I think the macro remains fairly comfortable for the OMCs upstream as well as for gas companies. Our preference still remains within the OMCs. I think HPCL probably continues to be something that we would look at. Our basic contention is that even with GRMs having gone down, the improvement in marketing margins at the same time means that integrated margins for the company continue to be in the range of around 6.5 to 7 rupees a litre, which is broadly in line with what our base case is, even though we were earlier building in slightly higher gross margins and slightly lower marketing margins. So whichever way the pendulum swings, as long as integrated margins remain in this range, which we believe is fairly sustainable, given the way that the macro is behaving, I think the OMCs remain in a fairly decent space. Having said that, 24 was an exceptional year from an earnings standpoint, so one should be prepared to see a little bit of a decline in earnings over FY25, unless margins, GRMs also recover and marketing margins continue to remain at the current very high levels, which I think is slightly unlikely. As far as upstream is concerned, the government has been extremely prudent in terms of keeping in pace with the changes in Brent and keeping realizations for them at $75 to $76. With gas realizations at 6.5, likely to improve a bit for ONGC as more of KG gas becomes part of the portfolio, which is subject to the HPHT premium. And from a consolidated standpoint, as I said, with HPCL's contribution, consolidated earnings will probably see a steady growth. Gas companies, again, we are seeing about, every report is highlighting 170 to 190 million tons of annualized LNG export capacity in the next 4 to 5 years, which creates a real possibility of a fairly comfortable supply surplus, at least over the next 3 to 5 or 5 to 7 years. So if LNG prices, remain in the $10 to $11 range, I think from a margin standpoint and from a demand standpoint, gas companies should do well. Our preferred pecking order right now remains at GAIL, continues to, I think, look good for us. We are positive on MGL, followed by a sort of cautious add on IGL, and yes, ONGC Oil India are the other names that we would continue to look at in this scenario.
Okay.
With Mahanagar Gas, I think.
All right. Appreciate it, Probal. Thanks a lot for joining in and filling us in with your thoughts. Wishing you a good Friday ahead.